In 2007, firms in our industry, the so-called alternative investment industry, it became possible to be public. And you were, I think, the second firm to go public after Fortress, as I recall.
They were a little one.
Yeah, they were a little one. And, but...
By a month?
Yeah. Well, actually, I think it was 33 days. But
that's the problem with precision in finance.
But you would think that being public has some possible negative ramifications. How did you think about going public? What caused you to do it? What got you over the hurdles?
I was a little leery about it, and I had a partner who was retiring, and most of you would not be aware of this, but in the sort of early 1980s, there was a firm called Solomon Brothers, and there was a fellow that ran it named Billy Solomon, and he retired, and there was another guy who became the head of the firm named John Goodfriend, and he sold the firm like a year later, and Billy Solomon, who had been CEO for like 30 years, got nothing. And I thought that was reprehensible. And because Solomon Brothers started as a little nothing, and it became the biggest bond house in the world, and was a real achievement. In any case, so I had a partner who was retiring, and he could have gone out at book value, which was about nothing, and I thought that was like a bad thing. It was unfair. And I also had a sixth sense that the world was getting way overvalued, and I just wanted safety. I wanted more capital in the firm. I also thought it would be a good idea if something bad happened to me, that there was something left for my family. I didn't think that was a bad thing. I also thought it would be good to have a currency, because if we were going to expand or pay people, it would be a good idea. And before, when we were private, everybody owned a big stake in their own individual product line and a little bit across the firm, but this way we could use stock as something that would bind everybody, and I thought that was a good idea. I thought going public would be a great branding thing for the firm. Little did I know that we exceeded that. And finally, I thought there would be an X factor. I didn't know whether it would be good or bad, but something big was going to happen as a result of it. And we really got overdosed with that one. We had the government, sort of wake up and different interest groups like attacking us for reasons that I never had imagined previously. But then we had 3 countries who decided they wanted to be major investors with us. And, it's one of those sort of polygamy discussions where you say, how many of these people can I deal with at once? And they all were desirable, which is, I guess, why there was polygamy at a certain point. And so I had the luxury of decision making, and we chose China. Now at that point, China had not invested in any company in any scale outside of China since World War II. So we became accidentally, and we didn't ask China to do anything, or any country. They just came out of the woodwork. That we became like a partner/symbol with China. It was the most amazing strategic thing I ever could have imagined. And the IPO itself was the second biggest of this decade. I don't know what to call it, from 2000 to 2010. Is that called the noughts? Right. Or I don't know what you call that decade, but the only one that was bigger than us was Google. And it was really like an amazing experience. And what we did, because I was very concerned about the conflict between being public and managing money for institutions, that I was really very difficult. I'm not really a nice guy, but I can be difficult. And in this context, I didn't want to have this conflict. And the only way I could figure out to resolve it was to have no fiduciary duty to our public shareholders, because I knew we had to have our fiduciary duty to the funds that we manage. And we had to be able to buy things at the right time and sell them at the right time and do the best possible job in the world managing money. And if that worked out fine, then the monies that were passed up to the parent company would be great. Everybody would prosper. But if we were worried about what to do from a fiduciary point of view for the parent company, then we might end up doing the wrong thing for our investors, and then they wouldn't like us, and then there's really nothing that you should be in business for. So I wrote a section in the prospectus that said, we are not a normal public company. That was a great hit with the underwriters, and they said, what do you mean you have no fiduciary duty? I said, well, you can't have two masters. And we're picking the people that we manage money from. And as a result of that, I'll take next to no compensation. I'll just take a draw. And I'll make all of my money with distributions from the parent company. So people will understand that I can do two things at once, but ultimately I want to make the right decision for the fund people, and that was the only way I could figure out how to avoid having that conflict. And actually, the firm runs now exactly the way it did when we were a private company. There's been no change.
The way I put it is, you don't have to make mistakes just because you're public, and you are perfectly able to make mistakes even if you're private.
Yeah,
as long as you have your head screwed on right.
Yeah, well, you try and do the right thing in every situation.
Yeah. What has been the impact of being public? In particular, you've been quite vocal about the fact that your stock is 75 to 80% undervalued. And what makes you think that? And when I went to Wharton, we were taught to ask, is it possible that you're wrong and the market is right?
It's possible, but unlikely. The way we value ourselves is pretty straightforward, easy to explain. We took like a 12% growth in assets under management, which is way lower than what we've been doing. You can sensitize this, but I'll give you the assumptions. We took what we've earned historically on our investments and lopped off around 200 basis points to be conservative. We could be wrong on that. It could be higher, it could be lower. And we set up a 5% dividend yield, and you multiply it out and you get like $130 a share, and the stock's at 26. So that's over 10 years, right? So I sort of look at it and say, could we keep coming up with new things and expanding? And there are no acquisitions in that. It's just regular old organic growth. And even if you knock it down to, I think it's like 6%, which is like almost doing nothing, because we've got the best performing asset classes in the world, that then gets to like 100. But any way you cut it, for us not to be able to do these types of things, you'd need a dramatic reversal in returns, or some kind of huge change in the ability to just raise money. And I think both of those are pretty unlikely, and it's just math, and that's how I do it.
I think that in your answer to one of my previous questions, you allowed the possibility, which I'm sure came as a shock to everybody here, that you can be difficult.
Not really. Friendly and lovable.
And yet,